let's talk about the money that's just sitting in your savings account. You might think it's safe, but here's the thing. It's actually losing its value day by day. The good news? You can do something about it. In this explainer, we're going to break down exactly how you can start investing in India and make your money work for you. Okay, let's get right into it.
You've felt this, right? That 100 rupee note that used to feel like a decent amount of cash, well, it just doesn't go as far anymore. It buys you less at the grocery store, less petrol for your bike, less of pretty much everything. So what is actually going on here?
I mean, look at this. It's the perfect example. Remember a few years back, 10 rupees got you a pretty big packet of Kurkure. Today, for that same 10 rupees, you get this smaller one. You're paying the exact same price, but you're getting less stuff. And trust me, it's not just about snacks. This is happening everywhere.
And the name of this silent money eater? It's called inflation. On average, the money you have is losing about 5 to 6% of its buying power every single year. So if your cash is just parked in a bank account, it's not just sitting still. It's actually shrinking. Its OCAT is going down.
So how do we fight back against this? How do we protect our money? Well, it all starts with building a really solid financial foundation. So let's talk about two of the safest places you can start, designed to keep your money secure.
Okay, first up, the good old fixed deposit, or FD. You've probably heard of this one. The concept is super simple. You're basically lending your money to a bank for a specific amount of time. In return for using your money, they pay you a guaranteed interest. It's simple, it's predictable, and it's safe.
And that interest is your weapon. Right now, banks are offering somewhere between 6 to 8% on FDs. Now think about it. If inflation is around 5 to 6%, this means you're not just keeping pace, you're actually getting a little bit ahead. Your money isn't just surviving, it's growing.
So let's sum up FDs. On the plus side, they're super safe, a fantastic safety net, and they help you beat inflation. The downside? Well, they're not going to make you super rich, and whatever profit you make is taxable.
All right, our second foundational investment is the Public Providence Fund, or PPF. This is a savings plan that's backed by the government of India itself, which makes it about as secure as you can get. But you know what? Its real superpower is something else entirely.
The PPF is currently offering a return of about 7.1% a year. That's pretty good, right? But here is the absolute game changer. The money you make, your profit, it's 100% tax-free. You don't pay a single rupee in taxes on your earnings. That's huge.
So, for PPF, the pros are massive. Totally tax-free profits and rock-solid government security. The main trade-off? Liquidity. You can't just pull your money out whenever you want, there's a lock-in period. This makes it perfect for long-term goals like saving for retirement or a house.
Okay, so we've built our fortress. Our foundation is secure, but protecting your money is just step one. What if you want to really grow your money? What if you want to build some serious wealth for the future? For that, my friends, we need a growth engine.
And that brings us to mutual funds. Think of it like this. A company pools together money from thousands of people, just like you. Then a team of professional experts invests that big pool of money into the stock market for you. And the easiest way to get started is with something called an SIP, which is just a fancy way of saying you invest a small fixed amount automatically every single month. So let's play with an example. Let's say you start a simple SIP of just 5,000 rupees every month. That's it. You set it and forget it. What do you think could happen if you just let that run for a long time?
Yeah, you're seeing that right. Nearly 6 crore rupees. By just investing 5,000 rupees a month for 40 years and assuming a pretty average market return of 12%, your total investment of 24 lakhs could balloon into this absolutely mind-blowing amount. That is the insane power of long-term investing.
The magic trick behind this is a beautiful thing called compounding. It's when the money you earn starts earning its own money. It creates this incredible snowball effect over time. And you can even speed this up with something called a step-up SIP, where you just increase your investment a little bit each year, maybe by 10%, to match your salary hike.
Now, as amazing as mutual funds sound, any smart investor will tell you never, ever put all your eggs in one basket. So it's time to talk about diversification. Let's add two very different players to our team. On one side, you've got digital gold. Think of it as the steady, reliable player on the team. It's a lower-risk asset that's known for holding its value over time. And on the other side, you've got cryptocurrencies, like Bitcoin and Ethereum. These are the high-risk, high-reward superstars. The potential for growth is massive.
Some have seen over 100% returns in a year, but so is the risk.
Okay, this slide right here, this is your cheat sheet. It brings everything we've talked about together in one place. You've got your low-risk foundation with FDs and PPF, you've got your wealth-building engine with mutual funds, and you've got your diversifiers, gold for stability and crypto for that high-growth potential. You see how each one plays a totally different role?
So, the big question is, how do you mix all of these together? Well, the perfect strategy for you really depends on your age and how much risk you're willing to take. So let's look at a few possible game plans. If you're young, let's say under 25, time is your biggest advantage. That means you can afford to be a bit more aggressive. So a strategy might be to put a big chunk, maybe 50% into mutual funds, and even 20% into something high risk, like crypto, with smaller bits in the safer options.
Now, as you get into your late 20s and early 30s, you might want a bit more balance. You're still focused on growth, but stability starts to matter more. So you might dial back the high-risk stuff a little and beef up your holdings in the safe and steady FDs and PPF.
And once you're in your mid-career, say 35 to 50, things change again. Now, protecting the money you've already made becomes a huge priority. So the portfolio becomes much more conservative, with most of your money split evenly across those stable, reliable options.
And that brings us right back to where we started. You've seen the tools, you've seen the strategies. The choice you make now, that's what will decide the future awqat, the future value of your hard-earned money.
Look, the bottom line is simple. You work way too hard for your money to just sit back and watch inflation chip away at it. It's time to put your money to work. It's time to start building your own secure financial future, and you can start today.